Personal Lines License Exam. Welcome to the quiz. What does UM/UIM coverage protect against in an auto policy? Is it A, uninsured and underinsured motorists who cause injury to the insured? Or B, damage to the insured's vehicle from an at-fault driver? C, medical payments for passengers only? Or D, liability when the insured drives a rental car? The answer is A. Uninsured/underinsured motorist UM/UIM coverage protects the insured and passengers by paying for bodily injury and sometimes property damage when hit by a driver with no insurance or insufficient insurance limits. Vehicle damage is collision/UMPD. Medical is MedPay. Rental is liability extension. Because UM/UIM covers injury from uninsured or underinsured drivers, this is its protection. Next question. In life insurance, a term policy provides coverage for: is it A, the entire lifetime of the insured? Or B, a specified period of time only? C, as long as premiums are paid, with a cash value component? Or D, only if the insured dies by accident? The answer is B. A term life insurance policy provides death benefit protection for a limited specific period, such as 10, 20, or 30 years, or until a certain age. If the insured dies during the term, the benefit is paid. If the term expires without renewal or conversion, coverage ends. Whole life provides lifetime coverage with cash value. Permanent policies have cash value. Accidental death is a rider. Because term coverage is limited to a set period, this is its defining feature. Next question. What is the primary purpose of the insuring agreement in an insurance policy? Is it A, to list the policy's exclusions? Or B, to define the premiums and deductibles? C, to state the insurer's basic promise to pay? Or D, to name the insured and the property covered? The answer is C. The insuring agreement is the heart of the insurance contract because it contains the insurer's formal promise to provide coverage by paying for losses or defending claims when a covered event occurs under the terms of the policy. This section clearly states what the company will do if a loss happens, making it the central commitment that defines why the policy exists. Policy exclusions appear in a separate exclusions section that lists what is not covered. Premiums and deductibles are financial details usually shown on the declarations page, not in the insuring agreement. The names of the insured and descriptions of covered property or vehicles are also found on the declarations page. Because the insuring agreement directly expresses the insurer's obligation to pay or perform, this makes it the basic promise section, while the other options describe different, unrelated parts of the policy. Next question. Which factor is most critical in determining the appropriate amount of dwelling coverage for a homeowner's policy? Is it A, the real estate tax assessment value of the home? Or B, the outstanding mortgage balance on the property? C, the cost to rebuild the home at current construction rates? Or D, the original purchase price of the home? The answer is C. The most critical factor for dwelling coverage amount is the estimated cost to rebuild the home using current construction materials, labor, and codes, not market value or purchase price, because insurance covers replacement, not resale. Tax assessment is for taxes, not rebuild cost. Mortgage balance protects the lender but may underinsure the full rebuild. Original purchase price does not reflect current costs. Because rebuild cost at today's rates ensures adequate protection without underinsurance, this is the key factor. Next question. What does a loss payable clause or loss payee indicate in a property policy? Is it A, the person responsible for paying the premium? Or B, the person who has an insurable interest in the property, like a lien holder? C, the independent adjuster assigned to the claim? Or D, the person to contact in case of an emergency? The answer is B. A loss payable clause or loss pay endorsement in a property insurance policy names a third party, usually a bank lender or finance company, that has a financial interest in the insured property through a loan, mortgage, or lien. In the event of a covered loss, the insurance payment is made payable to both the insured and the loss payee, or directly to the loss payee, to protect their financial stake and ensure the debt is satisfied. The person paying the premium is always the policyholder or insured, not the loss payee. An independent adjuster is a claims handler not involved in payment distribution. An emergency contact has no connection to claim payments. The clause specifically protects parties with an insurable interest via a secured financial position, like lien holders, which makes it the accurate description. Next question. An applicant omits a past speeding ticket on their auto insurance application. This omission is best described as: is it A, a waiver, or B, a concealment, C, an exclusion, or D, a warranty? The answer is B. When an applicant intentionally or unintentionally fails to disclose a material fact, such as a past speeding ticket on the insurance application, this is called concealment because it hides information that could affect the insurer's decision to accept the risk or set the premium. Waiver is the voluntary giving up of a right by the insurer. Exclusion is a policy provision that removes coverage for something. Warranty is a promise that certain conditions are true. Because the omission withholds important risk information, concealment best describes this action. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.